All right, everybody. Thank you so much for joining Quest Trust Company today on our self-directed Saturday class. I know the weekend, it's a 3-day weekend. We're all super excited about that. Believe it or not, it's this weekend's kind of special to me because I don't get a lot of Mondays off throughout the year. Even when we have like a Veterans Day or something like that, I'm one of those workaholics. I always end up working. But what's unique is in the month of September, Quest is hosting a ridiculous amount of specialized events for everybody. So I know if you're out there and you're joining us via StreamYard, if you're joining us via YouTube, if you're joining us via Facebook, you probably want to check out some of the big events that we're going to have coming up. Probably the largest one that I think that we all know about is going to be the Quest Expo. At Quest, we do our best to really put on as many educational events where people can come in, they can learn a brand new topic, a brand new area, in a safe environment, and it's always free. But once a year, we host a really large event where we bring in speakers from across the U.S., about 30 to 40 of them. None of them are there to sell programs, right? They're strictly there to educate you on different topics and what I label as alternative investments. This could be oil and gas and mineral rights to investing in small businesses to real estate being notes and subject tos and fix and flips and rentals and all sorts of things. So it's the only event each year we do have to charge for. And right now tickets are on sale for $250 a piece. If you'd like to attend, send me a private email and I'll get you a discount on it. I don't know what that discount would be. I'll do my best to get you $50 off or $100 off or something along those lines. But send me a private email. I'll put my email right down there in the chat box so we can go ahead and get started with those type of things. Ultimately, guys, get some snacks, get some drinks. This class will probably last about an hour, and I want you to leverage the chat box. Right? Understand the chat box there is for you guys. It gives us a chance to ask the speaker questions. It's going to be coming up here in a minute. Right? It gives you a chance to pitch your own investments. If you're a wholesaler, if you're a syndicator, if you're raising capital, use that chat box because everyone will have a chance to see it. Remember, this is going on 3 different platforms, YouTube, Facebook, and StreamYard. So however you are joining us today, we're glad you're here. We're glad you're with us. So without any further ado, I want to talk a little bit about the class today before I make the introduction. But one of the things that I think they miss the most when we talk about doing any investments is the cycle itself, the market cycle, the economy. Is it up? Is it down? Should I buy? Should I sell? So what's funny is we wanted to really bring in someone that is their main focus today, is teach us and talk to us about all sorts of different strategies that can go in when we're dealing with these economic cycles that just go through drastic changes, right? So without any further ado, I want to go ahead and bring on a close friend of Quest, right? Mr. Rico. Oh, man, I was just practicing it too. Rico Ferrer. Did I say it right?
You did. You said it very well. Thank you.
All right, Rico. So I'm glad you're here with us. So what's going to happen is I'm going to be in the background. I'm going to turn the floor over to you. And when you're done, maybe we'll ask some follow-up questions and go through those type of things. Okay?
Sounds good. Thank you. Appreciate that.
Floor is all yours.
Thank you. Appreciate that. I hope everybody's doing well. I want to be respectful of everybody's time, so I'm going to go ahead and jump right into this. Basically, a little bit about myself. My name is Rico. I am a partner with House Tour Investments and also the VP of Operations for NJ Legacy Fund. What we do as a company is we're a private lender to residential and commercial real estate transactions, i.e. investors throughout the U.S. My educational background, I have degrees in finance and economics from UCF. Obviously, when we graduated was right after September 11th. So those degrees, I was not able to utilize them at all, as you can imagine. So I went into the real estate market and became a residential appraiser. I did that for the better part of about 4 years. Around 2005, the market kind of settled down a little bit. So I went into what my educational background was. And I became a business financial advisor and a registered investment advisor with Merrill Lynch from 05 to 08. And 08, because then we had the real estate crash in the market that everybody, I'm sure, took place in as well. So I've had a very lucky run that since graduating, I've gone through at least 2 crashes. So why Merrill Lynch? You had to have a Series 7 license. It's an SEC license for general securities. I had an S66 license, which is a registered investment advisor license. I've had a Florida 215 license, and I was also a charter retirement planning counselor. Soon after Merrill Lynch, I became basically a real estate agent, and I've been in real estate ever since. That was roughly about 2009 that I went to the marketplace, and I'm currently still licensed as a real estate agent, and I'm also a mortgage loan originator. Because of those licenses, I've taken part of a lot of different aspects in real estate. I've been part or subject to part of about $100+ million in real estate transactions, whether that's acquisitions, that's underwriting, that's financing, refinancing, selling, fix and flipping, you name it. It adds up to just over $100 million over the past 10 years or so that I've been involved deeply in real estate. And what I found is that on the lending side of real estate, it's actually where the most profitability is with the least amount of risk. So in today's discussion topic, I'm just going to cover 5 different things I think are very key. And as I was telling Derek when we were speaking offline, is that there's a lot of things that we have the jigsaw puzzle for, but we don't know how it all just melts and goes together for you to understand and make good decisions regardless of what you're investing in. If you understand where the market is going, you'll know exactly what you have to do, whether you have to buy, you have to sell, you have to hold. Doesn't matter if you're holding stocks, if you're holding mutual funds, if you're investing in bonds, if you want to be in real estate, it doesn't really matter, but you have to know where the cycle is going so you avoid the wallets. So for you to understand that, we have to discuss bell curve. We're going to discuss economic cycle. We're going to discuss the culprit of all this, which is the Federal Reserve, specifically the Federal Open Market Committee, also known as the FOMC. We're going to discuss private lending, which is the part that I feel is the more risk adverse and also the most profitable section of investments. And then we're going to discuss what assets we partake in to be able to do this private lending. So without further ado, I want to start with something very simple. We probably all know what capitalism is. I'm going to give you my personal definition of what I understand capitalism to be. Capitalism, first and foremost, is what moves the U.S. and world economy. But in simplest form, what capitalism really is leverage. It's the ability for you to produce above and beyond what you as an individual can do. So if you look at it from a business standpoint, if I give myself 24 hours a day to produce, I'm limited by my personal capability. But if I leverage employees, now I'm leveraging myself maybe 5 times, 10 times, 100 times, which means that now it's not only what I produce, but I also benefit from what another 10, 100, 5 people, whatever the case might be, produce. And no industry does this better than the banking industry. And the reality is that they created this. And if you guys have done any kind of research, you probably come across a family called the Rothschilds. So if you haven't, that's something very interesting. I won't cover it during this presentation, but something very interesting of how banking basically originated back in the 1700s, even though it's been around for a lot longer than that. So before we go into this, we have to understand, now we know what capitalism is, but who is capitalism? So I'm going to give you a quick breakdown of this. So as consumers, we go to commercial banks. We put our money in the bank. Now, commercial banks also put their money somewhere, and that's central banks, which is the commercial bank's bank. And then the central bank is basically composed, in the US at least, by the Federal Reserve System. They are the overseer of banking, and they also implement monetary policy in the US. Central banks also have banks that they do business with. Now, this is basically the top of the pyramid, which is called the BIS, or the Bank of International Settlements, and that's a central banks of all the ones that are in the world. In the US specifically, you have the central bank, you have the Treasury Department, and you have the IRS. That's the delta, basically, of our entire economic system. So the way that it works is this way. The Treasury Department prints money. The distribution arm of the Treasury Department is the central bank. The central bank gives that money to commercial banks for them to distribute to individuals like you and myself, to the consumers. The IRS is the entity that collects the interest rate on that money that the Treasury Department printed, that gave to the central banks to distribute to commercial banks for us to borrow. That's the whole trifecta. So if you haven't understood that, that's a very key part of how the funding mechanism of the economy operates. Then you also have other parts of that mechanism, which is where that money is traded. So you have the NYSE, New York Stock Exchange. You have the CBOT, the Chicago Board of Options Trade. And you have the CBOE, Chicago Board of Options Exchange. That's where money is traded back and forth. On a global level, those exchanges might be the Nikkei, might be the FTSE, for example, might be the Hang Seng, which are the China, Japanese, and UK stock market. That's where money is being traded. And then other entities are important worldwide. You also have the IMF, International Monetary Fund, which basically is they focus on growth and prosperity for 190 countries, which are members of the IMF. You also have the World Bank, which is low and middle income governments. They basically go ahead and fund those governments to basically improve the economy within. And there's many, many other individuals who are involved in capitalism worldwide, which we're not cover here, but that gives you at least a good flavor that there are entities that basically make up what we understand to be capitalism. So let's go ahead and start with some of the things that we say, and I'm going to show you what the illustration of those comments really is. So the first thing is, I'm sure in business, some people have heard, or if I've even said themselves, let's get back to basics, right? You've gotten too far out from where you started from. You want to get back to your original roots. In relationships, you're probably going to say, I want to get back to the way that we were. You know, we used to be so good 5 years ago, and now we barely talk to each other. We don't do the restaurant outings. We don't go to movies. We don't vacation. You want to get back to basics so you can basically reinforce the relationship all over again. In manufacturing, they sure don't make it like they used to. Something as simple as the frying pans. Back in the day, they're made of cast iron. Nowadays, they're made of aluminum. If you get a pan hot enough and you put it under cold water, it's done for. It starts bending, it starts warping, doesn't work anymore. And for the individuals that are a little bit more mature, then you'll see things like, you know, kids these days. They used to be so good back in the day. Kids these days are just disrespectful. They're yelling, all these kind of things. But the thing is that when we verbalize these things, that represents one very simple chart that we went and covered when we did statistics for those of you that took it in college. And that is the bell curve. So what is the bell curve? The bell curve, you see this vertical line that's in there in the pink space, that's called the mean. That's the average, right? And then you have this thing on the bottom called standard deviations. Standard deviations is how far you get away from the mean. And this is the same thing that we just talked about. Let's talk about Papa John's. Let's say that Papa John's, which specializes in pizzas, let's say that 2 years out, they say, hey, we've done really well in pizzas. Let's go ahead and start getting involved in burgers. So now they do burgers and they do pizzas. Well, if you get involved in burgers, your pizzas are going to suffer a little bit because now you're putting some of your resources into specializing and perfecting the burger. Let's say 5 years down the road, you say, hey, we've done well in pizza. We added the burger situation. We had an increase in income. Let's get involved in tacos. So now they've gotten involved in tacos. Now it means that the burgers that they were good at now suffer. And the pizza, which was the original thing, further suffers. At some point, all three of those businesses are going to suffer because you're spreading your resources across three different things. Those are your standard deviations, which are the pink, the blue, and the green that you see on this chart. So when a company realizes that they've gone too far away from what they normally and are really, really good at, they return right back to the mean, right back to their original roots. And they say, you know what? We've gotten way too far away from what we were doing. Our businesses are suffering. They're not being as profitable. We have to go ahead and sell off the taco business, let's sell a burger business, and let's get back to just doing pizzas. Now, this chart, if you can keep this in your mind, we're going to utilize the bell curve to explain to you how the economic cycle works. This entire chart represents 100%. So the mean on each side is 50%. The right side is what we would call the bull market. When the bull market goes up, and it reaches 1 mean, 2 mean, 3 mean, that's when you start having the curvature that you have to get back or go into a crash cycle and return back to the center, to the original roots, called consolidation. On the bear market, which is the exact same thing on the opposite side, it's the same thing. When the economy is going too low, it gets to a point where it says, you know what, we're low enough, let's go ahead and get back to the mean. So if we talk about the economic cycle, keeping this chart that we have discussed here, the economic cycle and the bell curve in mind, here's what it looks like. So the economic cycle works this way. You have basically an expansion phase, you peak out, then you go into recession, you go into depression, then you bottom out, then you go into recovery, you go into expansion, and that repeats over and over and over again, right? If we remember the bell curve that we just talked about, and you look at this line right here, that's diagonal, that's just very consistent, that's the mean of the bell curve. And if you look at these peaks and troughs in this chart, those are your standard deviations on the bell curve. So what happens is that when you get too far away from the mean, it reverts back to the center, whether it's on the bull side or the bear side, and it does that consistently. So what anybody, including financial advisors, try to tell you is, listen, you're going to get a return, average return, hopefully per year, depending on your risk tolerance, somewhere between 6% and maybe 12%. But you have to ride those waves. And when you ride those waves, you go through emotional situations. When the market's going up, you're happy, you're great, you can't believe it, you're ecstatic. You think that'll never stop. And then when the market goes down, you're going through depression, you're going through all these emotions like, man, I shoulda, coulda, woulda, why didn't I? That's the emotional roller coaster that goes hand in hand with this emotional cycle. But at the end of the day, the market's always going to continue going up, and you want to be in that average, which is the mean. Now, the question is, what is it that creates or impacts these fluctuations in the marketplace? And the number one culprit is the Federal Reserve System. So the Federal Reserve System is comprised of multiple different things, but there's one specific culprit in here, which is called the FOMC, or the Federal Open Market Committee. And they're in charge of basically three tools, which we're going to discuss here shortly, that is what causes these corrections in the marketplace. So the FOMC has three tools, and they basically have a monopoly over money supply and inflation. So the three tools that they have is that they can increase basically member reserve requirements. Let's do this in a way that you all understand. I have a minimum that I have to maintain in my banking account, whether it's my checking account or my savings account. If not, the bank charges me fees. Let's say it's $1,500. If I go below that, they start penalizing me because I have to keep a certain minimum balance in my account. The same thing happens with the central banks to commercial banks. They say, hey, listen, however many deposits you have, 10% has to be in deposit with the Federal Reserve. If you have $100 million in deposits from your clients and they put in savings accounts and they put in CDs and whatnot, 10% of that money has to be with us. The second thing that they can do is that the FOMC can buy or sell securities in the open marketplace through its member banks to either increase money supply or decrease money supply. And the money supply is the money that we as consumers can borrow from commercial banks. The second thing is they can decrease and increase interest rates. That also affects us because it dictates the rate at which we can borrow this money from commercial banks. So when the Fed raises rates, money becomes more expensive for us. When the Fed decreases rates, money becomes less expensive for us. So let's discuss these one by one. Reserve requirements, we just discussed this. Federal Reserve requires banks to have either more or less money in deposit with them. When those reserve requirements go down, that means that the money supply is healthier, which means there's more money for us as consumers to borrow. The money supply, what the Federal Reserve does is they'll go to member banks and they'll say, listen, I need you to go out to the marketplace and buy me bonds or securities. So what they're doing is they're exchanging goods, in this case, investments, for cash that they have in their coffers. So that will replenish the coffers of the commercial banks. That means that they're going to be cash rich. That money is the money supply that we can borrow from. Like anything else, supply and demand, when you have a lot of supply, you have to get that stuff out there very, very quickly. And usually, if you're doing a good, you're going to decrease the price because you're going to basically want to get this inventory out to you. In the bank's case, to motivate us to take out loans, they decrease interest rates so that banks can generate loans. So that's how the money supply gets fueled. The Federal Reserve will say, buy me securities. They give money to the commercial banks. In exchange, they get securities. That means that they're increasing the money supply. The vice versa, or the opposite, is also true. If they want to decrease the money supply, they'll say, hey, I want to sell securities. So now they'll give the commercial banks their securities and they'll get money back in exchange, which decreases the amount of money in the system for us to borrow from. And the last thing is the interest rates. Now, the interest rates affect something that's very critical. Think of a seesaw as you see in this chart. So when the Federal Reserve increases interest rates, it has a direct impact on the bond market. So let me give you an example. Bonds are issued as something called par. Par means that it's basically a coupon that says I owe $1,000 to XYZ company. I'm paying 10% for the utilization of that $1,000 over the next 30 years. So that means that bond is paying $100 per year in semi-annual payments, which is $50 every 6 months. Then that bond goes into the secondary marketplace to start trading. Now, what directly impacts the bond market is the Fed raising and decreasing interest rates. So let's say that the Fed, as it's doing right now, is increasing interest rates. So if you increase interest rates, that means that the bond market is going down. Because what happens is, let's say that now, because the rates increase, that bond is yielding 15%. So it's not 15% of $1,000 means that now you owe me $150 per year. It means that 15% of what number yields me $100 per year, which simple math lets you know it's $666.67. That means that the bond market just took a hit of nearly 34%, 33.66% to be exact, 33%, sorry, to be exact, on that money. When those things happen, the bond market says, listen, I'm going to step away for a little while. I'm not going to be buying any more bonds until the Fed stops messing around. The opposite is also true. When they decrease interest rates, the opposite happens. So bond market, they go up, the interest rate on that bond goes down, let's say to 5%, because now the bond prices have gone up. Now, why is this important? Banks, whether they're commercial or they're private like myself, what happens is that our liquidity source, when we originate a loan, we don't hold those loans, just like your commercial banks don't hold their loans. They package them and they sell them off to Wall Street, right? So what happens is that becomes a bond yielding X interest rate. So as the Fed decreases and increases interest rates, it literally affects the capital that they have in these bonds invested. Fed goes down, their capital gains goes up. Fed interest rates go up, their capital gains becomes capital losses. And that's what lets them exit and enter the marketplace. So let's talk about how does it all work, which I just kind of covered that. So if the economy is to be stimulated, and we're going to discuss this at length here shortly with what happened with COVID, the Fed will decrease rates, they'll decrease reserve requirements, they'll buy bonds and securities, and that's how basically they stimulate the economy. That's how you go into recovery, expansion, and peak of the economic cycle. If inflation is to be curtailed, as is happening right now, so as of the beginning of 2012, the Fed will do the complete opposite. They'll start increasing interest rates. They'll increase reserve requirements. They'll require the member banks to have more in deposit with them. And they'll sell bonds via their commercial banks to remove some of that cash from the money supply. That's where you go into recession, depression, and trough, which is exactly what we're going through right now. If you guys have paid attention to what the Federal Reserve has been doing, 2 Fridays ago, they announced that they're going to have 4 to 5 more interest rate hikes. So this is supposed to be the correction that we've been expecting in the real estate market, because now money is becoming more tight and more expensive. So let's talk about what happened since COVID. So COVID occurred or started occurring, basically hitting the news August 2019. By March of 2020, we had the WHO, which is the World Health Organization, say, hey, we're in a pandemic. Soon thereafter, Trump said, hey, we're in a pandemic. Everything shut down. Remember those days? I'm sure you do, because we all got hit by it. And then what happened? The Federal Reserve, not even a couple of days later, they released $700 billion, which is now what we're talking about impacting the money supply through the member banks so they can stimulate the economy. Something else that happened is that the SBA, through their PPP program, they put out another $669 billion. Something else that happened, the SBA also had the EIDL program, over $351 billion just through SBA loans, not even counting the PPP program. And if you guys also recall, the administration at the time also had that paycheck program, which we all got somewhere between $1,200 and I want to say the peak was $2,400 per family. And I believe they sent out 2 to 3 checks. So add that up to it. The total amount roughly that was infused into the economy was almost $3 trillion, a humongous amount of capital to be infused into that. Now, they started getting curtailed in January 1st of 2022, which is this year. So I'm going to show you in a chart shortly how that impacted the S&P 500 and therefore how our economy is behaving by just these simple moves that the Federal Reserve is doing. So the first move is in 2019, the Federal Reserve was decreasing interest rates, right? In 2020, if you look at these dates, March 15th and March 3rd, that coincides with when the Trump administration and WHO declared that COVID-19 was a pandemic. So they did an aggressive interest rate cut. So they decreased 150 basis points, which at that time, interest rates had reached 0. You can go out and get a 30-year loan for 2%. The SBA was throwing money at you. We were being kept afloat by the PPP program. Our families were being assisted by the paycheck program. And they were just trying to stimulate the economy because everybody was shut down. They're encouraging to work from home, to do Zoom meetings, to basically conduct as much business as you possibly could if you weren't an essential worker from home. So this coincides with a lot of money being plummeted into the economy, the Federal Reserve decreasing interest rates to encourage us, the consumers, to go out and get loans so it can still continue at some point to expand the economy. The Federal Reserve didn't touch interest rates until earlier this year. So 2022, when did they start increasing interest rates? March of 2017. And they've been doing increases. Now we have inflation. We've had 8.9% inflation. So because inflation has been going up that high, it's affected the individuals that are on fixed salaries. Those of you that are employees or have friends that are employees, can attest. When you go to the grocery store, things are more expensive. If you wanted to go buy a vehicle, that vehicle is more expensive. God forbid real estate became untouchable for a lot of different people. And now if they couldn't buy real estate, now they're forced to rent. And as rents, because people couldn't buy, more people became now renters. That means that the rents kept going up. So if you wanted to rent a single family home, eventually that became out of your reach. So maybe you have to settle for an apartment. So people have had to adjust, because even though the cost of living has gone up and of goods and services you want to purchase has gone up, the salaries of employees hasn't. So what happens is that as things get more expensive, you're basically leaving out a big section of the economy behind. So then those individuals get to the point that says, okay, what am I going to use my money on? Obviously, you're going to put food on your table. You're going to keep a roof over your head, and you're going to keep your essential things that you need for living within your budget. The things that suffer is that now you don't have money to go spend in a restaurant. You don't have money to go spend in movies. You don't have money to go spend in leisure items. So then what happens is that other industries start suffering, the entertainment industry specifically, restaurants, movie theaters, theme parks, traveling, etc., because there's no spendable cash for those industries. When that happens, that's where the Fed gets involved and say, hey, inflation's gotten too out of control. We have to go ahead and mitigate this. Let's go ahead and decrease the money supply. Let's increase interest rates to basically thwart some of the borrowing that's going on. And let's also increase the reserve requirements of member banks, so there's less money out there to basically have consumers borrow. So let's go ahead and chart this on the S&P 500 since 2018. So the first circle that you see here, which is basically 2020, roughly March, that is when Trump administration and WHO announced that there was a pandemic, lock everything down. As you can see, the market just collapsed. So if you remember the bell curve, here we go. The mean is that line that we see here diagonally, right? So now we have this very, very abrupt decrease. The Fed sees that. So what do? Hey, we have to halt that. We're crashing. We have to parachute this a little bit. Let's decrease interest rates. So they start decreasing interest rates. They also start putting money into the economy, the PPP program, the SBA program that we talked about. You have the paycheck program that came in, SBA coming in, EIDL, all these systems came in just to funnel money into the economy. So you had the two interest rates decreases, which by, let's say, May or so of 2020 is when it bottomed out. A humongous amount of capital was infused into the economy and rates were 0%. Business owners started borrowing. And what do? You take that capital and you start better training your employees. Maybe you invest in better systems. Maybe you change the way you conduct business, because a lot of brick and mortar disappeared. A lot of people are working from home, myself included. So what happens is we reinvent ourselves and try and figure out how can I continue conducting business and obviously stay within the parameters of what COVID is causing for business. So then you have this amazing jump in the expansion of the economy. We have almost double-digit returns. Real estate is growing in double digits annually. It's been a phenomenal market for real estate. Now they get to a point, now you go past the mean, you blow right past it, and we're this other circle right around here in the latter part of 2021 and beginning of 2022 is when we've priced out a lot of the marketplace. This is where the employees are getting hurt, because at this level, they can't afford real estate. Food is getting really expensive for them. Renters have had their rent increased substantially, because as the valuation of real estate goes up, so does your real estate insurance, your homeowner's insurance or renter's insurance. So does your real estate taxes. And you have to pass this on to your renters. So they're getting pummeled by those situations. The cost of your cars goes up. We saw the gas prices reach almost $5. Everything is getting more expensive. So when the Fed realizes that we're impacting the majority of the marketplace being the consumers, then they say, hey, we have to curtail this, because eventually we're going to have nobody that can afford anything. And it's going to affect all kinds of different industries, and we're going to have a really big problem in our hands. So the Fed starts raising interest rates. When they start raising interest rates, that means that they're slowing down the amount of money that's being borrowed, making it more expensive. They're removing money from the money supply, so there's less money to be borrowed. And banks, what they start doing is that because the bond market now is getting affected, remember, as interest rates go up, bond market goes into a crash cycle. then what the bond markets are doing is they say, hey, listen, we are used to being the liquidity source for banks when they originate mortgages. At this point, we're not buying any more mortgages. So then what happens is that commercial banks, your JP Morgans, your Chases, your Wells Fargos, et cetera, and your private banks like myself that we originate loans, then what happens is that we have no liquidity source. And the way that we keep originating loans is that we originate a loan, right? We get the documentation and then we sell that loan off to Wall Street. We get our capital back. We originate another loan. So we can make, let's say, $10 million seem like $100 million because we're just going to get our capital back and keep reissuing loans. Now, when our liquidity source, which in this case is the bond market, gridlocks, that means that now we don't have this recurring capability of loaning money over and over and over again. Now we're limited to only the money that we have within our balance sheet. So if we have $10 million, once we loan that money out, we're out of capital, right? So then what do we do as banks? When I have limited capital, then I have to make sure that the person that I'm going to lend that money to is really, really qualified. So then what happens? We require better DTI, debt to income ratios. We require better debt service ratio. We make sure, or now we require you to have a better FICO score. Maybe we were doing loans at 600. Now we require 640, 650, or 700, depending on where you're at. And then also because of limited capital, I have to get the biggest bang for my buck. So now the interest rates on your loans go up because, hey, I only have $10 million. So I have to make sure that I get as much money for that capital as possible. And the last thing that happens is we don't let you borrow as much. Maybe before we let you borrow 90% of your purchase, we may be down to 80%, 70% now. So that's what happens and what you probably see when you go out to the marketplace and you want to get financing. And that's because the Federal Reserve or the FOMC is implementing their tools to basically control inflation. And that's how we get impacted as consumers. So this is basically how you see the Federal Reserve operating. All these red circles that you see after the fact is the Fed raising rates. And it's curtailing, going to a trough. Then you see that it bottomed out and now we're going back up again. Just last month, if I'm not mistaken, the Fed say, hey, we're finally stapling off inflation. We're no longer seeing inflation at 8.7. I believe we were at 8.4, 8.3, if I'm not mistaken. So now we're seeing that we're stapling up inflation. Well, what does that mean? This isn't a crash. Most people say that according to economic definition, when you go into recession, is 2 decreasing quarters. Well, there's no reason for us to go into a real crash. What it is a consolidation. We've expanded way too fast. So now we have to consolidate that business for us to go into our second leg of growth because we just had a crash not too long ago. And that cycle typically is between 7 to 12 years that you're going to have a crash cycle. So commercial banking. Commercial banking is where we utilize or put our money with them. Commercial banks don't allow you to be on the same side of the equation. Commercial banks take your money and you put their money with them either in a savings account or you put it into a CD. Now, the national average for the savings account is 0.08%. You might as well just be earning zero. And if you're doing a 5-year CD, even if you're doing a jumbo CD, the national average, you're still sub 1%. So the national average currently for 30-year mortgages is 5.5%. So do some quick math. You're letting the bank have use of your capital for somewhere between 0.08% and 0.7%. They're turning around and lending that money out at 5.53%. They're making 1,000% in most cases with your capital. Do they let you participate of that capital gain? No, they don't. All you're earning is that 0.08 that they promised you, the 0.72 that they promised you. But they're going out and doing mortgages with that loan. And they're making way more than 5.53% because remember, they originate the loan, they sell it to Wall Street, they get their money back, and they keep doing that over and over and over again. And they're making yield spread because obviously they're originating the loan at 5.53. They might be selling in the background at 4. So they're still making 1.5 per dollar that they're originating. On top of that, they got their fees that they're charging in the front side. Origination fees, their lender points, whatever. They have a bunch of fees there. So they don't let you participate of that. The opposite of that is private banking. Private banks like myself, for example, or like yourself, that you have a self-directed IRA. You can be a private bank too. You can fund these deals, absolutely 100%. So what happens is private banks, they want to partner with you. We want to partner with you. We want you to be on the same side of the equations as we are. So there's a better risk reward because the same capital that you give us, we originate loans with, but you're going to participate of the yield that we originate those loans at. The other good thing is asset backed. So we originate a mortgage collateralized by real estate, whether it's commercial or residential, and that's the guarantee that we have, right? The next best thing is that we originate short-term loans, 12 months or less, and we're dealing with investors. Investors don't want to be tied into a loan very long. So if you're a fix and flipper, have friends that are being fix and flipping, or even watch TV, HGTV, or Flick This House, for example, you know that they want to get into a house and out of it as quickly as possible, because the longer you stay in the house, the lower your return. So if you buy a house, you want to rehab it within 1 or 2 months, and you want it off your hands within 3 months, so you can get your capital back and repeat the process over and over again. Now, these loans, unlike what's called qualified mortgages, your typical 30-year mortgages, where you're paying 5.56%, these loans you're paying double digits, 10%, 12%. So obviously, they don't want to be in those loans very long. So let's talk about the what ifs. There's always a risk in every single type of investment. In commercial bank, what's the risk there? What if the bank goes under? Well, if the bank goes under, you have SIPC and you have FDIC, which are the insurance policies that guarantee to return your capital, whether that is in deposit or whether that's investment. During 2001, the FDIC increased their limits to $250,000. Those limits are currently $100,000. Now, what most people don't know is this. If you read in the FDIC website what they have to return to you in the event of a bank going insolvent, they can take up to 20 years to give you your money back. Now, at the end of those 20 years, let's say that you lost $100,000. Now, keep in mind, if you had $250,000 within the bank, that $150,000 is bye-bye. They're only responsible for up to $100,000. That's why it's sometimes a good situation to have multiple bank accounts with multiple different banks. If you have more than $100,000, so you have that guarantee across multiple banks. The other big thing is this. They only are responsible for returning to you that $100,000. Whatever interest you could have earned over those 20 years, they don't have to give it to you. Same thing. They can foreclose in real estates, but you don't partake of that. You have the FDIC insurance. That's it. Economic collapse, FDIC response. Private bank, very different. What happens if we go insolvent? Well, we have the guarantee of real estate. We can go ahead and foreclose on that property, take that money back. We can do something called deed in lieu, where we tell the client, listen, you can't make your payments. Things are going south. That's not a problem. Go ahead and give me the real estate. We'll eradicate the loan. Nobody's the wiser, and we can go ahead and move on. We as the bank can then do two things. We can resell that property to an investor, which, by the way, we're in a very good position because our loans are usually 80 to 90% during really good market conditions of the LTV of the assets value of the real estate, which I'll go into that in a little bit. So if we take that property back, we have a very good, healthy equity position that we can just wholesale it and not only get our capital back, or in this case, your capital back, we can also even make a profit on top of that. The other part that we have to manage risk is that, just like commercial banks, we can go ahead and sell it to the secondary marketplace and get our money back with no buyers. So what are some of the properties that we lend on? We have residential. Those are your typical single unit. They could be condos, townhouses, single family residences. We can invest in multifamily. On the residential side, it's duplexes, triplexes, quadruplexes. That's where the residential basically ends. When you start going above 4 units, now you're going into commercial. Now, we don't invest in industrial park. We don't invest in office space. We don't invest in strip malls and the such. We stick to where people have to reside in. So we go into multifamily. Multifamily, we stay within 5 and 30 units because that's usually $2 million or less of mortgages. That's where we place our money. Let me give you an example of a project. Let's say on the fix and flip side, we're dealing with an investor. The investor picks up a property, and we're going to use simpler numbers than what this reflects. So if you look at the new construction, somebody says, hey, I want to go ahead and build a property. Okay, no problem. What's the land value? $100,000. Okay, based on land value, I'm going to give you up front $50,000, right? If they default, I own the land. I can make the difference, which is another $100,000. So I'm very, very safe. And then we have a draw schedule where we say we're going to also create a draw schedule for you of $150,000, which is what it's going to take to build this house, where we're going to give it to you as a reimbursement of your own capital as you build the property, submit that documentation. We'll send an inspector out, and we'll reimburse you the money as you're building the property. So we're always in a position of safety when it comes to these investments. So that's how new construction basically works. The other part, when you do renovation financing, same thing. Hey, I'm buying this property at $100,000. Once it gets done rehabbing, it'll be worth $200,000. It's going to cost me $50,000 to rehab, and the project, I should be in and out of it within 4 or 5 months. Okay, no problem at all. We'll go ahead and give you this financing. We'll provide you 80% of the total loan to cost, which is the summation of your purchase plus your rehab, and we're going to withdraw or hold your construction budget. Again, that's for our safety and our investor safety. So they buy the property, they start rehabbing, they submit the draw schedule to us, and we'll reimburse based on the scope of work that they submit to us so that we're in a very safe position. Why do we do that? Let's say that you have one of these guys that's been watching way too much HGTV, how to flip this house, and has never done it. They go in and start cutting corners on how to do a rehab. Well, we send an inspector out. If for some reason they haven't done the work correctly and they're requesting, let's say, a $10,000 draw, doesn't pass inspection, we don't give them $10,000. We say, hey, listen, it's not done up to code. You have to go out, get this redone up to code, and then when it passes our inspection, we'll go ahead and reimburse you. So even if they spend another $5,000 to correct this, we don't reimburse them. We don't reimburse them that. They ate that $5,000 because that's their mistake. We still reimburse the $10,000 they requested, but that mistake that they did, that's not our problem. So we always make sure that we err on the side of safety for our capital and for our investors. The last type of asset that we deal with, rental assets. There's some individuals that want to build a rental portfolio. So they might buy a house, again, in some form of disarray. They might improve it, do a value add. The property's going to be worth more, and then they're going to basically cash flow it. So we help them with the capital to buy the property. We help them with capital to update the property. So usually something very cosmetic. They might change some cabinetry. They might update the bathroom. They might update the kitchen a little bit. They'll update the flooring. They might paint the house. Minor stuff. It's cosmetic stuff. And they'll go ahead and refinance out of it into a 30-year mortgage, and they get us out of loan. And that's typically how private banks go about investing the capital of investors. So I want to open up for questionings. You can ask me anything pertaining to this particular presentation or anything else that you might think can be even related to this particular presentation. And I'd be more than happy to answer those questions.
Sure. So we do have a couple of them, and I'm going to rephrase some of the questions that we have here, okay? But one of them has to come up with the midterm of the presidential election.
Sure.
So as it starts to come to a close, and so I'm just kind of rephrasing this to, because we always try to keep our best to not pitch political views and things like that. Mm-hmm. But how do you think that's going to affect what some people are considering to be almost an upturn? All right. Just in general. Is that going to affect things on our market? Is that going to affect things on our interest rates? Is that going to affect things, just from that standpoint? And I'm really summarizing the question.
Sure. No, it's quite all right. I mean, this is a very dicey topic, but I'm gonna try and be as politically correct as I possibly can. Me personally, in my experience, I don't pay too much attention to political things. I'll tell you why. The agenda, and I'm gonna be real cautious. I'm stepping here. I'm gonna tiptoe around this, but there's an agenda that is provided by bank that is already implemented. Whoever is in office doesn't really impact that agenda. They just have to be on board with saying, hey, are you on board to implement what we have to implement from the banks inside? So it doesn't matter who your president is. Those things do not impact where we're going economically. It really doesn't. No president, believe it or not, has that much power. They're just the face at the time of the political party that's in control at that time, but it doesn't impact anything economic is going to happen. People get just caught up and distracted on these things of, Democrat, Republican. I saw a painting, I would say about 10 years ago, that was the most simplified version of this. And it was a bald eagle perched on Capitol Hill on top of Congress, right? And it had its wings spread out like so. And one wing was painted red, one wing was painted blue. And the caption on the bottom read this. It said, it doesn't matter what wing you are on, the flight path never changes. That's the most true statement that you can ever understand. So I don't really focus.
I really like that. I just like that analogy. I've never heard of that analogy, but I like it.
It was a painting that I saw. It was phenomenal. So, I mean, I would tell you that don't get focused so much on the politics. Listen more to what the Federal Reserve is doing. The Federal Reserve will tell you what's going to happen. It's as simple as what I just spoke about. When they're raising interest rates, it's because the economy is about to curtail. Think of a wave. When a wave's crescendo and about to crash, that's what interest rates do. That's all it is. So when the Fed starts raising rates, keep a very close eye, because that's a correction to the downside of the stock market. When the Federal Reserve decreases interest rates, they're looking to stimulate the economy. That's all you got to remember. That's the most important thing you have to understand.
So right now, if I wanted to either borrow money from you, invest with you, something along those lines, what would you consider to be one of the better ways to go about that?
How to do it, or what we invest in?
No, right now, Derek Long has cash, whether it's in my IRA, whether it's in my checking account personally. I want to invest with you. I want to, what's the best way I can go about doing something along those lines?
So we have a 506c fund, which is basically a registration that we have to carry out with the SEC to tell them that we have a fund, but it's not securities. So we're exempt from SEC registration. But we have to tell the SEC anyway, so they can say, yep, you guys are exempt from registration. That's not a problem. How do we avoid that? By dealing with accredited investors. Now, we do have a limited amount of individuals that we can deal with that are non-accredited. And I believe that's 35 individuals. The rest can be as many accredited as we want. So the way to do it, go ahead, I'm sorry.
No, I'm sorry. So for some of those non-accredited, because that was actually more of the person's question was, could they be labeled sophisticated under the 506B type things? Would you be able to accept that in rare cases?
The answer is no. It's very clear as far as to what's considered a sophisticated or accredited. They're synonymous. They're one and the same. So we have a fiduciary responsibility as a 506 fund where the investor has to prove, believe it or not, that they are accredited. And let me tell you the exact reason why. Let's say that I don't do my due diligence. And let's say Derek says, hey, man, I'm accredited. And I take him at his word, right? And he gives me X amount of dollars. The minimum amount for basically any investment is $25,000. So let's say, hey, I'm accredited. I want to try you guys out. I have $25,000. Here you go. I don't request from him documentation from his financial advisor, from his tax attorney, from his CPA that confirms that he's an accredited investor. And let's say that, God forbid, we lose the money, right? Derek can say, hey, I didn't know what I was doing. I thought this was a great investment, but I lost the money. He's got so much legal capability to come after us for not doing proper due diligence, because the courts really say that when you're sophisticated, you should know better. You should be a well-read person. You've been involved in these kinds of investments before. You have been around the block. So that's where we have to make sure that you are accredited. Now, as I explained to it, it's not that the investment isn't good. It's just that the same paintbrush applies to any investment. And we have to treat them as the most risky thing that there is.
So with those, I know you operate, or currently you're in Florida, you said earlier, correct? So does it matter really where I live? Does it matter what I can do, or where I'm located, whether I need to borrow money or whether I just want to invest with you? Does it matter where I'm physically located? It
does not, because, for example, we operate in 7 different states. That's where we operate. Now, the thing is that every state that you go into, the way that you originate your mortgage, you need a promissory note, you need the mortgage, you have all this documentation that you need. If you're trying to do it on your own, you want to get with an attorney. You want him to, and a real estate attorney to be specific, and you got to pay him, whether it's hourly or how he's going to charge you, to basically draw or draft the documentation that you will have to utilize in that specific state, to do a proper lien in real estate. If you remember 2008, a lot of these mortgages were missing stamps, they were missing notaries, thing was erroneous, they're having outdated clauses. And if you have somebody that's savvy within the real estate legal realm, you can literally just make that mortgage and note null and void. That means that you have no claim over the real estate. That means you have no guarantee. So you have to do a proper lien on the real estate, that if something were to happen with that investor, whether they don't pay you, you have to foreclose on them, you have to do a deed in lieu, whatever the case might be, you have to make sure that your documentation is on point with the legal statutes of that state. But
you
can
my language.
Yes. So the thing is that it doesn't matter what state you're in. For us, for example, we have all the documentation that we require regardless of the state that we're operating in, because we are make sure that documentation is correct for all the states that we operate in. So if God forbid something happens, we have to reclaim that asset, we can.
So a couple things, Rico, is just as we close things out, right? Can you give our viewers and our listeners just one final piece of advice, maybe something that just comes from you or your organization, just in general?
Sure. There's multiple pieces, but I think that the most key thing is this. When it comes to economics and finance as a whole, you have to really just do some critical thinking on your own. This information is not easy. It's not easy to find. Nobody wants you to understand the secret sauce or the recipe for how things happen, because then you become competition, and that's across any industry. Yep. So banks don't want you to have the secret recipe of how they do things. Coca-Cola doesn't want you to have the recipe of their soda, because you become competition.
Absolutely.
So the thing is that the common denominator across anything is human beings. So the best thing I can tell you is this. Most of us, when we have capital, we want peace of mind. That's what we want. And sometimes if you want the peace of mind, you hire somebody out to provide you that peace of mind. You say, hey, this guy knows what he's doing. He's going to give me what I need. I don't have to worry about anything. Some people, they have heavier stomachs. They can go out and assume risk, and they can still sleep at night. For those individuals, I recommend go out and do whatever it is that you want to do it on your own. You will be successful at it. If you have the tenacity, you have the grit to stay in it, to learn, to kind of, scuff yourself along the lines. And that's fine. That's all part of business. We've all done it. I don't know of a single business owner that doesn't have, wounds and scars from getting to where they're going to get to. Now, there's some people that don't want to deal with that. They say, listen, I don't want the headaches. I don't want the stresses. I just want to get my check in the mail. I want to be able to sleep at night. I want to spend time with my grandkids, with my kids. I want to travel, whatever your thing is. Those individuals, you go ahead and hire a professional to do that. In my opinion, one of the better areas to invest money, and I've invested in a lot of different things. I've done great in the stock market, and I've gotten my tail kicked. I've been all over the place in multiple marketplaces. What I realize is that on the banking side, we can control the two things that most people cannot control in most markets. We can control the risk, and we can control the return. So how do we control the risk? If the economy is going down like it's doing right now, where we have a correction, I say I'm not going to let you borrow 90% of what the asset's worth. I'm going to let you borrow 70%. So if the market does do a 20% correction, I'm still safe, right? So I'm controlling the risk because I control the leverage that I'm willing to let an investor borrow collateralized by this asset. And I can, and even if somebody tells me this asset based on appraisal is worth $500,000, I say, yeah, you're right, but I'm expecting a 15, 20% correction in the marketplace. So for me, that asset's worth $400,000. And on that $400,000, I'm gonna let you borrow 80% or $320,000. So I'm $180,000 from appraised value because I'm smart enough to say, I have to go into future value of this asset because you might hold this for 6 months, you might hold it for a year, and I have to predict what that asset bill will be worth. Second thing is I control my return. When the market goes down, I don't have the secondary market buying my notes. I have to get a higher yield. That means that every dollar that I have to maximize its return. So then I go ahead and say, hey, I was willing to get 10% before because I was able to sell this note to the marketplace. Now I don't have a buyer on the backside. I have to get paid 12%. So now I'm letting you borrow less money and I'm charging you more. So I'm controlling both the risk and I'm controlling my return. So I honestly do believe that one of the best areas to be in is in the loan origination or note buying sector of the marketplace. It's even better than being on the fix and flip marketplace because you can go into a house and be in this situation. Like I have some personal friends that I told them, hey, listen, if you're in a fix and a flip right now, get out of it as quick as you can. We're going to go into correction. Because if you bought the house and you took 3 months to rehab the property, you very well have been in that crashing side of the wave. And when you go sell it, like it's happening right now, before realtors were having 20, 30, 40 offers above ask. Nowadays, my appraiser friends, my inspector friends, my realtors have seen a 75 to 80% decrease in their business. So then what happens to that fix and flipper? Hey, I predict I was going to sell it for $500,000. Yeah, but now the correction is coming. That means that
you're 400 and you're over leveraged. You're
100%. Either your profits gets decreased substantially, or you might be underwater.
Yeah. Well, Rico, thanks so much for joining us. I really do. Don't go anywhere. Real quick, if you guys are listening, make sure you check out his website. I know it's flashed up there a couple times. Actually, so I was playing around on your website while you were talking. Sure. It's actually really well put together. So make sure you guys check it out. I have it up there on the screen. Lastly, do not forget about our Quest Expo. So if you like these type of classes, if you like these type of events, this is the reason the expo that we're hosting is right around the corner. Right. Remember, guys, we can go ahead. If you're partaking in this broadcast right now, make sure that you just send me an email right there. It's IRAspecialist@questtrust.com. We will go ahead and knock off $100 for any ticket that you'd like to purchase. So whether that's a VIP ticket, which I think there's only 2 or 3 left, don't quote me on that. They might already be gone. And lastly is just the expo, just if you want a general admission ticket. And Rico, like I said, don't go anywhere, but thank you so much for joining us, everyone. Make sure you check out his website. Give him a call at 561-307-3002, right? And that's really it. So thanks, everyone, for joining us here on Self-Directed Saturday. Bye, everybody.
Thanks, guys.